Welcome back to Investing Talk Podcast.
Today, we're looking at Lumentum.
And let me tell you, the tension in the room regarding this specific ticker is absolutely palpable today. We are looking at a stock that has pulled a massive, frankly, almost unbelievable 300% plus rally in the last year alone.
It's a vertical line.
It is. It's the kind of chart that triggers two very different instincts, Either you want to high-five everyone because you own it, or you want to run for the hills. So the big question is, what are we looking at? A bubble waiting to pop, or is this the new engine of AI?
That is the question of the moment. And to answer it, we have to really look at Lumentum. They aren't just making little parts. They're building what the market is calling the optical supercycle for AI data centers.
As usual, before we start, subscribe, like, and comment to this video to support the show. We read every comment, so let us know what you think.
So why does this matter right now? Think of Lumentum as the ultimate picks and shovels play for 2026. For the last couple of years, everyone has been, well, completely obsessed with the chip makers.
The NVIDIA's, the AMD?
Exactly. But while everyone was staring at the GPU, Lumentum quietly cornered the market on the lasers that actually move the data between those chips.
See, that's a great narrative, and I get the appeal. I really do.
Ah.
But I have to play the skeptic immediately here. We are sitting near all-time highs.
Yeah.
The stock is hovering around, what, $386?
Right around there.
If you bought this a year ago at $60, you're laughing. But for anyone listening right now, the fear is real. Has the easy money already been made? Is this the top?
It's a valid fear, a totally valid fear. But let's look at the numbers driving this, this insanity, because when you peel back the layers, it's not just hype. The fundamentals are actually shifting.
Okay, walk us through it. What on earth justifies a chart like that?
It comes down to revenue acceleration. I don't use that word lightly. It is absolutely exploding. If we look at the full year fiscal 2025, revenue was $1.65 billion.
Okay.
That was up 21% year over year. Which is solid, right? That's a good growth stock.
Sure, 20% is respectable. It's healthy.
But look closer. The most recent quarter, Q1 of fiscal 26, came in at $533.8 million. That is 58.4% year-over-year growth.
Whoa, wait, so that went from 21% to 58%.
A massive acceleration curve. You almost never see a hardware company triple its growth rate like that in just a few quarters.
That is a huge jump. 58% is... That's software territory, not hardware. Something has changed.
Yes, exactly. And it's not slowing down. We have Q2 earnings coming up in just 3 days, February 3rd. The guidance for that quarter is even higher, between $630 and $670 million.
They're guiding for momentum on top of momentum.
They are.
Okay, I have to acknowledge, that growth is impressive. But I have to scrutinize where that money's coming from. When I dig in, I'm seeing over 60% of their revenue is now tied strictly to AI infrastructure in the cloud. They are putting all their eggs in one very, very hyped basket. If that AI spend cools off even a little bit, if Google or Microsoft pauses one data center build, that growth rate collapses.
That's a fair risk, and we will get to the risks, but this is where the bull case really lives. It's not just about selling more stuff, it's about keeping more of the money. We have to talk about the margin story.
Margins are always the truth teller.
Yes, they are. In fiscal 25, their operating margin was 9.7%. That was up over 1,000 basis points from the year before, which was already great.
Okay, so.
But in Q1 of fiscal 26, operating margin hit 18.7%, and gross margins are approaching 40%.
Hold on, how did they almost double their operating margin so quickly? That sounds like aggressive cost cutting. Did they fire half the company?
No, that's the beauty of it. It's the product mix. They are shifting from selling commodity parts to these high-value, high-margin products, specifically the 1.6 terabyte transceivers and their proprietary indium phosphide lasers.
Okay, stop there. Indium phosphide. Let's unpack that. I see NNP all over the reports. Why is that so special?
It comes down to material science. Silicon is great for computing, it's the brain, but it's actually not that great at generating light. Indium phosphide, or NNP, it's a compound semiconductor that is exceptionally good at emitting and detecting light at the speeds AI needs.
So silicon is the brain, but NNP is the nervous system.
That is the perfect analogy, and right now there is a physical bottleneck. If you try to push that much data through older tech, you get heat and signal loss. NNP solves that. And here is the kicker. There's a massive supply shortage for these lasers.
Ah,
Lumentum has them, and they are charging a premium. That's pure pricing power dropping straight to the bottom line.
so they have the secret formula for the AI nervous system.
Yeah.
Okay, let's run the safety check, though. Companies growing this fast can get reckless. What's the balance sheet look like? Cash.
It's a fortress. They have $877 million in cash and short-term investments.
And debt.
They just secured a new $400 million revolver that matures in 2030, and it is currently undrawn. They have plenty of liquidity.
Okay, and are they burning cash to fuel this growth?
No, they are cash flow positive. Adjusted EBITDA was $264.2 million for fiscal 25, and they're using that cash to expand manufacturing capacity for AI. No dividends, just reinvesting to capture the market.
Which makes sense.
Yeah.
But let's talk about this moat. You mentioned the NMP lasers. Is that really defensible? Can't competitors just spin up a factory and catch up?
It's not that easy. In mid-2025, there was a 25 to 30% supply gap in the market for these. It takes years to build these fabs and get the yields right.
I see.
But more importantly, they've gone vertical. By acquiring CloudLight and making their own transceivers, they are now a systems partner, not just a vendor selling a laser diode. That makes them much stickier.
Fundamentals look good, I'll grant you that. But
Yeah.
the chart looks terrifying. Let's pivot to the charts for a minute.
I know, it looks like a rocket launch.
It really does. I mean, the stock went from around $60 in early 2025 to the $370 to $390 range by this month. That is a 370% gain in a year. Right now, we're hovering at $386, just off the 52-week high of $401. It's vertigo-inducing.
It is a parabolic run, I agree, but you have to interpret this as strength, not necessarily a bubble. Technically, it looks incredibly healthy. We have a classic golden cross in play.
Explain that for anyone who might not know the term. Why does that matter?
A golden cross is when a short-term moving average, like the 50-day, crosses above a long-term one, like the 200-day. It signals that momentum has fundamentally shifted up. Right now, the 50-day is way above the 200-day. The gap shows how powerful this trend is.
It's definitely trending up. But where's the floor? If this thing turns, where do you even think about buying?
Support seems to be building in that 350 to 370 range. We've seen it consolidate there, which is healthy. The resistance is obviously that psychological $400 level and the all-time high of $402.79.
And if it breaks that on earnings?
If it breaks 402, we enter blue sky territory.
Meaning there's no historical price history to act as a ceiling.
Exactly. No one is sitting at $410 waiting to break even. Everyone is in profit. It becomes pure price discovery.
That's exciting, but also dangerous. I'm looking at the beta. It's 1.51.
Which is high.
Right. For anyone who doesn't know, that means this stock moves 50% more than the market. It is volatile. You have to be ready for the swings.
True, but look at who is holding it. Institutional ownership is at 94.05%.
94%. That is incredibly high. That leaves almost nothing for retail.
Yes. The smart money owns almost the entire float. Pacer Advisors, Swedbank, Corient Private Wealth, they're all buying in. This isn't just retail hype. Institutions are locking up the shares, which creates a supply squeeze.
A massive vote of confidence. Okay, let's check sentiment. The big money is in, but what is the street saying?
This is where it gets interesting.
Yeah, this is where I found a really weird discrepancy. The consensus is moderate buy, but the average price target is like $222. That's way below the current price.
It implies a 40% crash. What's going on there?
That's just the lag. The analysts are chasing the price. They can't update their models fast enough. But if you look at the recent updates, Citi just raised their target to $450. Stifel and Needham are raising targets too. The street is scrambling to upgrade estimates before the earnings report.
So the old data is dragging down the average. It's a distortion.
Exactly. The narrative has shifted completely.
But I have to point out a red flag. Insider selling.
Okay, let's hear it.
Last 90 days, insiders sold $7.3 million worth of stock. When I see management selling into a rally, I have to ask, did they know something we don't? I looked at that too, and you have to contextualize it. That $7.3 million is only, it's 0.04% of shares. It's a drop in the bucket.
0.04.
Tiny. With the stock up 300%, this looks like tax harvesting. Maybe buying a new house. It doesn't look like a lack of confidence. The institutional buying completely outweighs it.
Fair enough. It's not a mass exodus. So the big catalyst is earnings.
The big one. February 3rd, this Tuesday, Q2 earnings. Management guided for an EPS between $1.30 and $1.50. The market expects a beat. If they guide up again, I think the stock breaks $400 and never looks back.
I'm not letting you off that easy, though. Let's look at how this goes wrong. Time for the bear case, because this valuation is making me sweat.
Okay, hit me with it.
Risk number one is valuation vertigo. We are at a nosebleed level here. The forward PE is nearly 100. 100 times earnings for a hardware company. Why should I pay that?
That is the standard bear argument. But you have to look at the PEG ratio price to earnings to growth. It's around 1. Because earnings are growing so fast, that 58% revenue growth, the high PE is actually justified if they keep growing.
A very big if. Which brings me to risk number two, competition and tech shifts. What if the industry moves to something like co-packaged optics CPO faster than they adapt? Their moat could just evaporate.
A valid concern, but Lumentum is already pivoting to CPO. They aren't sitting still. And for the next 12 to 18 months, they have a lead on the supply the current architecture demands. They're entrenched with the hyperscalers.
But that entrenchment is also a risk. Risk three, customer concentration.
Yeah.
60% of revenue from AI and cloud. If one major customer, just one, cuts CapEx for a quarter, this thing tanks.
That's the reality of being a pure play. You live and die by the cycle, but right now that cycle is expanding, not contracting.
Okay, we've weighed the growth against the valuation. It's decision time. What's the score?
I'm giving this a bullish score of 8.5 out of 10.
8.5? That's aggressive.
It's not a 10 because of that valuation risk. 100 times PE is scary, I admit it. But the momentum, the 58% growth, the margins, it is just undeniable. You do not short this kind of strength.
So what's the thesis? The elevator pitch.
Simple. Lumentum is the indispensable valve for AI data. You cannot build a modern AI data center without their lasers. They are the toll booth on the information superhighway.
And the time frame.
Short term, I'd say buy into the Feb 3rd earnings. A beat could push this to 420, maybe 450. Long term, 3 years out, hold for the optical supercycle. I think we target $500 plus by 2027.
If you buy this, you need a stomach of steel. It's a rocket ship, but rocket ships shake. I am cautious at $386. I have to be. But I cannot bet against that growth rate. The numbers are just too strong.
That's the dive on Lumentum.
Don't forget to subscribe, like, and comment to this video to support the show. See you in the next one.